Okay, so this next session is going to be talking about drawing liquidity and anticipating where price is going to go. So let's say we are here at this time. This is London session. We have tapped into here, for example, we're on a 1 hour time frame right now. Usually for drawing liquidity, I like to look for a major, this is a high time frame because low time frame, we're taking a lot of entries, right? But we want to know overall where the high time frame wants to move. That's the main thing for a high time frame drawing liquidity. Once we tapped into this 1 hour supply right here, what I'm looking, if I was here, for example, is okay, well, we were in a high time frame, but we were looking like a mitigation model. Okay, we're looking to mitigate right down here, see if we will push out even further. So once we tap into this 1 hour supply, we need to find where are we most likely going to go on a higher time frame. We're most likely, I'm seeing here, this demand right here. This looks like a QM model to me. Internally, we are bearish, and then expansion, right? We are high time frame. So internal mitigation trend, pullback, expansion. We can expect price to come down here for another expansion, or price fails and creates lower low and then starts coming back down, which is later what it did. Price started coming down. And I wouldn't be marking this either because I know this is inducement. Why? Because price did not come back to mitigate any of this origin here. So my draw on liquidity, your draw on liquidity is either internal or external. For me, on hot time frame, I can use both. This is an internal high time frame draw on liquidity on the 1 hour. Let's see how big this POI is. This is pretty good size for high time POI. What does that mean? Let's say price was here, okay? I wake up. I don't wake up here, but let's say you wake up, you see prices here, it did a sweep here, and then see, and then it broke down. So if you were here looking at price right here, I would not be bullish anymore. Why? Because price tapped into its high time frame supply. I'll be actually looking to short. And if I have a bias, what is my overall direction of bias now? Bias is bearish all the way until we reach this 1 hour PY. Why? Because we're doing mitigation cycle, right? So if I woke up here and I've seen price here, I'll be looking at supply zones. Okay, supply areas for us to short. I'll be continuously looking for short and seeing if we can short all the way down here. I'm not going to take one trade to short down there, but I'll be mainly focused on shorting and understanding that if we're trying to, price is trying to come down there, these lows we're creating are most likely targets. Okay, these are most likely weak lows. So I'll be shorting to take those out. So if you can see based on how price delivers here, we have an impulse model. We probably entered here. And here we either broke even or I don't know, depends on your trading plan. Could have broke even here. And then price came up even higher, and we probably had some type of OB on a different time frame. Let's see, a strong high right there. And then essentially we start breaking down, right? So this huge leg here, this was an impulse, but this leg in general was a structural leg, and now we're breaking down. So if we're breaking down, I could already anticipate this low getting taken out before anyone even sees the confirmation here. Why? Because I saw this high time inducement here, and I already marked price is going down here. So why would I be shorting or why are we longing? I'll be shorting here. Remember the models I taught you guys? So let's say we're using one of the models here. Because we have so much structure here, this is an hour and 30 minutes of structure. That means we're expecting a lot of candles on a 1 minute to do an hour and 30 minute move down, right? So what does that mean for us? That means instead of looking for a basic impulse model, we are looking for something more complex. We're looking for structure to hold. If we're looking for structure to hold, what do we have here? Well, lows getting held, okay. And you wait for this low. This is a previous low, up into the origin, that made a high. So in this situation, I'll be using this model here. Again, I don't use this model often unless price is giving me this type of delivery. Breaks the low, then we get it. Let me change this real quick. Then we get an entry here on this OB, newly formed supply. This is one of our entry models I literally taught you guys. Okay. Changing character. Uniform supply. Straight down. Now, playing target here. I would have caught a 12-hour trade right there off of understanding draw and liquidity. Okay, so now you guys understand that. Well, what are we looking here? When we take out external lows, even if we're in downtrend, we are expecting some type of pullback majority of times. There's some type of pullback. It may not always pull back even to the origin here. Most times it pulls back to 50% and just drops more, right? So that is why we need to understand we are targeting this low here, not necessarily fully going for this target here. You can if you want, if you think your entry is going to hold. Sometimes, like I said, once you break an external liquidity point, swing point, we can expect retracement. And if trace is already this much, you get stopped out break even, or it might even sweep you before it does a real move. So it's not certain, right? I'd rather 37 hour, I'd rather confirm my 12 hour. And let's see what happens here. Will price do a retracement back up to at least 50%, or will prices continue in the downtrend? Majority times it does a retracement, but look at the time. It's already 2 or 3 o'clock. There's no volatility for price to continue pushing this much up in price. The price of the range of this time period is now very small until we get to a time where range creates bigger ranges again. So that's another thing with time. You want to focus on time. If it's already low volatility time period, we're not expecting price to come back up here doing big moves. We're expecting a smaller range to be created, and this is what happens. You create a smaller range here. Price, you could have traded this if you want. I would be looking for short here to target this low here. Like I said, because our draw is lower. Let's see, we have an OB here. Look at that. We tapped it right there. An OB on the 5 minute. And then we enter off. I see fair value gap here you can enter off of with confirmation. Don't really see much on OB. I see a seconds OB on a low time frame right now. I would have entered on the seconds here, ARR here. But that's one way you could anticipate where price is mostly going to go in a direction of price based on draw on liquidity. This is an extremely important topic. I think most people don't go over in detail. They make it very too plain. And again, when we break down structure like this massively, we create new ranges, right? Create new ranges, okay? This is still Asia session. We don't expect huge moves, create new range. And guess what? Because we're in a downtrend in our call liquidity, we're taking out this inducement time frame. Our target is already down here. What are we doing? Okay, we're expecting strong high, weak low. People say this is all hindsight. You can see this while price is live. But are you really thinking about this? That's a real question. Are you asking yourself these things when price is moving? If you're not, then you're doing something wrong. You have to know and ask yourself these questions. Where price is likely to head? Am I trading in the right direction? Is it a mitigation or expansion cycle? How is price delivering? All these things. Price is delivering an impulse model here. Why? Because look at there's minimal structure here. There's some, yes, there's pullbacks here, so yes, but majority of it is an impulse. Okay, and when you have an impulse, we can enter directly off the candle break. Now, yes, here you would have got a stop loss here on this break right here, which is unfortunate. And this is another thing I want to talk about, guys. When there's low volatility, price is more likely to do more consolidation and sweeps in a PY than if we were in a more active time period. So for this situation, and during low session volatility, I would be putting limit orders here. I'll put a limit order here, have my stop loss a little bit above there, and then as soon as candle break, I would have had my stop loss here. Probably would have took a small loss, would have re-entered if I wanted to, and my stop loss would be moved here. Like I said, for limit orders, this is mandatory in my opinion. Move your stop loss. If you don't move your stop loss, you wouldn't have taken the tiny loss the first time. You would have kept it, but yeah, and then you target the low. Look at the confirmation. Look at this. This is why I think confirmations is the easiest thing ever in trading, in that like you can't go off. I think confirmation is kind of like indicators. It's not fully, but it's kind of like indicators. But indicators tell you what price is currently doing. Everyone knows price is currently creating creating that bullish OB here to move up, right? Everyone sees this, right? When now everyone is no indicator is going to anticipate and tell you price is going to go further down and take out that demand zone. This is also why people are marking these wrong. People mark this as a fair value gap. I don't use fair value gaps as my POIs to enter off of the trade off. I only use it for entries. I don't use it for POIs. I'm looking for areas to enter. My POI would have been here. So I wouldn't have taken this trade at all. And there's no confirmation here. Okay. No volatility either. There's no confirmation there. I would have not even been looking for longs. I would have just targeted that low. I would anticipate price rating that low and continuing further down to my 1 hour POI. This may look complicated at first, but once you start practicing this, you see this happen all the time. And boom, there you go. So this is why I also don't hold all the way here. Because price can easily on low time and do a lot of manipulations. What I say about price on low time frame, low time frame has a lot of manipulation if you're trying to catch a high time frame move. So never try to catch a high time frame move unless you're already in the most best potential spot. Like for example, this is a high time frame leg. If you're shorting at the very extreme part of the leg, you most likely will there less manipulation because price when price is in equilibrium in the middle, it's gonna do a ton of sweeping. If you're trading at the best price here, it's very less likely for price to come all the way back up there unless it doesn't want to come down here, right? So this is why drawing liquidity is so important. You guys can even see here, for example, I can show you guys an example. Let's see. See if I can find an example here. This right here is inducement at a time. You literally would not be showing this at all. This is where people get it wrong. People ask me, how do you even know prices do not even look for confirmation here? There's confirmation here on the seconds for sure. Even in 1 minute. There's a 0.11% move down. There's definitely confirmation there. People are just gonna hit stop loss because they don't anticipate this as inducement. There's an origin above here on a different time frame I see that price reacted to and broke down. So this is what I said. Inducement, this is a fake charge, change of character, and price people are long here and just getting stopped out because that time frame current trend is external is bearish. Until its own mitigation right here at this POC, which is one thing I'm gonna talk real quick. I don't use this too much, but POC is essentially point of control. Short-term point of control. Point of control is basically an internal uh, break and retest. You guys think like that. So it's applied, we broke, and now we came all the way back to retest um, previous resistance, now support to push up. So came back to the point of control and boom, create a new trend, which is actually just a expansion that failed. And now it's expanding down to create a new trend to further price down. Most likely, why? Because look, price took out external liquidity. When price is out external liquidity, one or two things happen. Most times it's a retracement or it causes a whole entire market shift. So again, putting the pieces together is super important trading. This is how essentially you should be trading every single day. You should identify drawing liquidity first. So this is my steps. Number one, identify my external structure, which is my trend. External trend. Write down my chart. Okay. Once I write down my chart, then I can know what to expect for price in terms of direction. Then I look for my drawing liquidity on high time frame. I don't use low time frame for drawing liquidity. Low time frame drawing liquidity is literally just for TPs, okay, for trades. High time drawing liquidity. And then I look for valid POIs, which is all OBs or sweeps I'm looking for. And then I look for confirmation, and enter. Confirmation, entry, trade management, boom. That's it. Make it as simple as possible. This may not look simple at first, but this is my typical checklist. Okay. You have a very high win rate putting all these things together. But if you're aiming for these huge R's only, like 40 R, 50 R, you're not gonna have a high win rate. Aim for R that you can maintain every single day at a good win rate, okay? Otherwise, the psychology is gonna be bad with 10% win rate at 100 RR. Even with 100 R, 10% win rate is not good because your psychology is gonna be awful. This is the equity curve of someone with 70% win rate. It's like at 1 RR. So they can take a win, they can take a win, loss, win, loss. Okay. It's a lot more stable than someone with a 100 R 10% win rate, 100 R, oh my gosh. And then they keep losing, and then another huge push, and then keep losing for who knows this losing period can be how long. It can be very, very long. This is why psychology falls down to level systems based on what I'm trying to say. That will be a very ugly looking equity curve. You want something to look as close as possible to a 45-degree angle. Now, if you have a 90-degree angle, that's most ideal, but no one ever has this. So unless you're like gambling off something, earnings or some sort, but we're here to learn how to trade consistently for a full-time living and make bank, not gamble. So if you're trying to gamble, this is the wrong place. Sorry. So that is essentially how you put all the pieces together in trading.